All right, hello everyone. As a professor of taxation, I see it every single year, that end-of-year scramble. It feels like a mad dash, right? But here's the thing. It's also your single biggest opportunity to make some really smart moves. Moves that can save you a ton on your tax bill and honestly, just set you up for a much better financial year ahead. So let's get right into it. We're going to walk through my essential year-end tax checklist.
Okay, so here's the game plan. First up, we're tackling the most urgent stuff, your investments. Then we'll dive into that big December 31st deadline, hitting accounts and expenses. After that, we'll look at a sneaky deadline in January, some brand new filing rules you need to know about, and finally, we'll pull it all together into your action plan. Ready? Let's go. The clock is definitely ticking.
And this quote, it really hits the nail on the head. Look, ideally, tax planning is a year-round thing, but these last few weeks, this is where the magic happens. It's when certain doors slam shut and others swing wide open. And I gotta be crystal clear about this. A lot of what we're talking about today aren't just nice-to-haves. No way. If you miss the deadline on some of these, that's it. The opportunity is gone for this tax year. Poof.
So first up, your investment review. And pay close attention to that date. We're talking before December 27th. Now you might be wondering, why so early? It's simple, really. Stock trades don't happen instantly. They need a couple of business days to settle. So to be absolutely safe, you want to get those trades done by the 27th, which means you need to be making those decisions, like, now.
Okay, so this is the big question you need to be asking yourself right now. Take a look at your portfolio. What's the story this year? Are you sitting on some big wins, some nice capital gains? Or, are some of your stocks in the red? Either way, it's not good or bad, it's an opportunity. Both situations give you a chance to play it smart.
All right, let's break this down. Let's say you sold some stocks and made a nice profit. You've got capital gains, and that means a tax bill is coming. But what if you have another stock that's down? You can sell that loser, and the loss you take, we call this tax loss harvesting, can wipe out those gains. It literally reduces your tax bill. What's even cooler is you can carry that loss back 3 years to get a refund on taxes you've already paid. Now, for you business owners out there, a word of caution. Doing this can mess with something called your capital dividend account. Think of the CDA as a golden goose for getting money out of your corporation tax-free. You don't want to mess with that, so please talk to your advisor. On the other hand, what if your income was really low this year? Well, that might be the perfect time to do the opposite, to sell a winner on purpose and lock in those gains while you're in a super low tax bracket.
Okay, hold on. Before you start selling everything that's in the red, there is a massive but you need to know about. It's called the superficial loss rule, and trust me, the CRA is watching for this. They don't like it when people try to create, fake losses just for the tax benefit.
So here's the trap, laid out plain and simple. You sell a stock to get that nice capital loss, but then, and this is the key part, you or your spouse, or even a company you control, buys that exact same stock back too soon. And too soon means within 30 days before or 30 days after you sold it. It's a whole 61-day window you got to watch out for. If you do that, bam, the CRA says, nope, that loss doesn't count, it's gone. So if you're going to play this game, you have to sell, and then you have to wait. You have to stay away from that investment for at least 31 days. It's a bit of a waiting game for sure, but you absolutely have to play by the rules on this one.
Okay, investments handled. Now for the big one, the main event, December 31st. This is the hard deadline for so many things. Let's kick this section off by looking at your registered accounts, because there's a lot you can do here. So this table shows 3 totally different accounts, but they all share that same December 31st deadline. Let's start with your TFSA. This is a neat little trick. If you know you're going to need some cash early next year, pull it out before New Year's Eve. Why? Because on January 1st, whatever you took out gets added right back to your contribution room. If you wait and pull it out on, say, January 2nd, you have to wait a whole year to get that room back. Huge difference. Next, RRSPs. This one's simple. Free money. You have to get your contributions in before the end of the year to get the government's matching grant for this year. Don't leave it on the table. And finally, for anyone turning 71, listen up. This is it. Your last chance saloon to contribute to your RRSP. After this year, it's got to be converted to a RIF, and you can't put any more money in.
Here's another great timing strategy, this time for anyone using the home buyer's plan. Check this out. If you take money out of your RRSP for a down payment late in 2023, that 15-year repayment clock starts ticking right away. But if you can just hold off for a few days and take it out in early January 2024 instead, the whole repayment schedule gets pushed back. You basically buy yourself an entire extra year before you have to start paying it back. That's a huge bit of breathing room, all from just waiting a couple of days. Speaking of buying a home, we have to talk about the brand new account that dropped in 2023, the Tax-Free First Home Savings Account, or FHSA. And wow, this thing is a game changer. It's like an RRSP and a TFSA had a baby. You get the tax deduction when you put money in, just like an RRSP, and the withdrawal is tax-free when you buy a home, just like a TFSA. It's the best of both worlds. But here's the killer year-end tip. Even if you have $0 to put in it right now, just opening an account before December 31st is a huge move. It unlocks your contribution room for 2023.
And that room carries forward. You see, the lifetime limit is $40,000. You can put in up to $8,000 a year. So by just opening the account now, in 2023, you bank that first $8,000 of room. It doesn't disappear. That means next year, in 2024, you could potentially put in $16,000, this year's room plus next year's. It's an incredible way to get a running start on saving for that down payment.
Okay, we are still locked on that December 31st deadline. We've talked about accounts, now let's talk about the money flowing in and out, income, expenses, and charitable donations.
Now, for anyone receiving pension income, this is probably one of the best tax-saving moves out there. It's called pension income splitting. If you're earning more than your spouse, you can basically shift up to half of your eligible pension over to their tax return. So what's the point? Well, two things. First, you're moving that income from your high tax bracket to their lower one. That's an instant tax saving right there. But here's the bonus prize. It can actually let both of you claim the pension income tax credit. And that credit is no joke. It lets you get a tax break on the first $2,000 of pension income. So by splitting the pension, you could potentially double dip. That means you and your spouse could each claim the credit, sheltering a grand total of $4,000 of that pension income from tax. It's a fantastic deal.
All right, let's talk expenses. The rule for personal taxes is super simple. It's all about when the money actually leaves your bank account. The fancy term is cash basis, but all it means is you get the deduction in the year you pay the bill. So, for everything you see on this list, medical bills, donations, childcare, if you want to claim it on your 2023 tax return, you have to pay for it by December 31st. If that credit card charge goes through on January 1st, guess what? You're waiting a whole other year to claim it.
Now let's stick with donations for a second, because there is a major change on the horizon. It has to do with something called the Alternative Minimum Tax, or AMT. Look, most people never even hear about the AMT. You can think of it as a separate parallel tax system. It's basically a safety net to make sure that high-income earners who use a lot of deductions and credits still end up paying at least a minimum amount of tax.
So why are we talking about this now? Here's the deal. Starting in 2024, the rules for the AMT are getting a lot tougher, and they're specifically targeting things like the donation tax credit. So for those of you who are very generous and make large charitable gifts, the tax savings you get from that donation could be way lower next year. The bottom line? If you're planning a big donation, doing it before the clock strikes midnight on December 31st this year could save you a whole lot more money.
Okay, we made it past December 31st. You can breathe, but not for long. Don't relax just yet, because there's one more really critical deadline hiding in January that, if you miss it, could be a disaster for certain tax plans.
This is specifically for anyone using what's called a prescribed rate loan. It's a common strategy for splitting investment income with a lower income family member. For this whole setup to work, the person who borrowed the money must pay the interest on that loan by January 30th. And when I say must, I mean must. If they are one day late, the whole strategy blows up. All that investment income for the entire year gets dumped right back onto your tax return, and you could be facing a huge, totally unexpected tax bill. Seriously, circle January 30th in bright red on your calendar.
All right, now let's look ahead to when we're actually filing our 2023 taxes next spring, because there are a couple of huge rule changes that are going to catch a lot of people by surprise. And these are not small adjustments. We're talking about significant new paperwork for a lot of Canadians.
The first big one is about trusts. The rules have gotten way broader, and this is so important. For the very first time, something called a bare trust has to file a T3 trust return. And you might be thinking, I don't have a trust. Well, you might. Let me ask you this. Are you on the title of your kid's house just to help them get the mortgage? Guess what? That's likely a bare trust. Do you have a bank account in your name, but the money is really for your grandchild? That could be a bare trust too. So many of these informal family arrangements are now caught by these new rules. If any of this sounds even vaguely familiar, you need to call your accountant, like tomorrow.
And then we have the Underused Housing Tax. Oh boy. Let's be honest, the rollout for this has been a total mess, a real roller coaster. The deadlines kept changing, as you can see. But here's where we landed. Both the 2022 return and the 2023 return are now due on the exact same day, April 30th, 2024. Now, there is some good news. Starting with the 2023 tax year, a lot of Canadians who had to file before will now be exempt. But, and this is a big but, that change doesn't go backwards. If you were supposed to file for 2022, you still have to file for 2022. You can't escape it. So you've got to get that done by the April 30th deadline.
Phew. Okay, I know that was a lot. We've gone through everything from investments to these crazy new filing rules. But listen, the point of this isn't to make your head spin. It's to give you a clear to-do list, to empower you. So my question to you is this: what is the one thing, just one, from this checklist that you're going to tackle this week? Pick it, make the call to your advisor, and get it done. Because taking these small steps now isn't just about cutting your tax bill. It's about taking control and building a more secure financial future. Thanks so much for joining me.